Welcome, everyone, to Real Estate Radio, the most important hour of radio every Monday on 1580 AM, The Big Talker. Thank you for joining me this afternoon. For those of you who don't know or are not familiar, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. Within every market, there's tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 AM, The Big Talker. We had a lot going on in the markets last week that we really want to dive into today. A lot of you guys have heard about the Fed and Operation Twist and are trying to decipher what that means to you and how that can affect you and your real estate decisions. Joining me on our panel today to discuss all these items is Louis Cammarosano, the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as what's on deck this week that can affect you and your real estate decisions. Louis, are you there?
I'm here, Ryan. Good morning.
Good morning.
Good afternoon.
Good afternoon to me. Yeah, it's about 2 o'clock my time. Big day for us in the D.C. area. We have the big Redskins-Cowboys games tonight. So, and this is the first time in a long time we've kind of came out of the gate 2-0 with the potential to go 3-0 if we were to win tonight. It's been kind of crazy because we don't have the best sports town when it comes to winning as of late. So it's interesting to see the dynamic of when a team is actually winning, how people are just more happy and going about their days just in a different manner. It's quite interesting.
Yeah, we experienced that last year when the Giants won the World Series here in San Francisco.
Yeah, and it's just isn't it crazy how there's just a different feel about the city.
Absolutely.
And it's an incredible thing, especially when you haven't had a championship for a while and it actually comes. It does a lot of good for the city as well.
It even helps in New York when we were used to it, when the Yankees used to win all the time.
Yeah, exactly. Yep. I wanted to kind of jump in. One of the first things, Louis, is last week the Fed had their meeting, of which I think most of everybody already knew that they were going to take and start purchasing long-term treasuries, mortgage-backed securities, and get rid of a lot of their portfolio in the shorter-term ones. The only thing that was really different, and for you out there, all you guys out there that are trying to figure out, what actually took place, the Fed called this Operation Twist, which is essentially just them buying about $400 billion in long-term Treasury securities. They basically are selling off their short-term government debt and purchasing long-term. And what this is aimed to do is basically to keep long-term interest rates even lower. Now, I don't really agree with this. I don't really think that there's really any point in doing this. Interest rates are already extremely low. I don't know by giving even more incentive for lower rates that's going to bring even more people into the fold as far as being able to purchase a home or refinance, because you still have the same hurdles, also known as being underwater, owing more than your house is worth, so you're not able to refinance, and tighter lending restrictions, which has been a huge problem. But from the Fed aspect of it, if inflation, when it does eventually take place and they're going to buy these long-term treasuries, the Fed's going to end up losing money here. Louis, what do you think?
Well, I think just quick comments on what they did. It doesn't increase the balance sheet, so that made it look like, well, it wasn't quantitative easing. All they did was, take the short term and move into long term. And we've been saying that, purchasing these securities and keeping the debt going is really kicking the can down the road. And they've just made the road longer now by putting them out to the long term. But they've protected themselves against, rises in short-term interest rates. So they're taking all of this short-term debt and they're moving it, further out. Now, this is good for real estate, but as you point out, it'll drive the long-term interest rate down, but by how much? If you can't get the loan, it's really not that helpful to the real estate market, although in theory it should be. And then to the banks, it's probably not really good for the banks because it's good for people who want to refi. Now they can refi at a lower rate, so that really can't help the banks.
Yep.
So I'm not really quite sure. I think they did this more as a protective maneuver for their own portfolio, because you don't want to be stuck with interest rates rising on the short term and then having to pay the interest on them right away. If you can kick that can down the 10-year road, they're probably better off. But it really was a non-event
Yeah.
for the real estate market, and for the markets it was a negative because they were expecting some kind of liquidity to come into the market.
Yeah, there's also some article. David Joy, the chief market strategist with Ameriprise Financial, described this new measure as a net wash because there was no expansion of the balance sheet. And another
recharacterization of the debt that they have.
Exactly. And interesting because with the Fed coming out with the language, I believe it was the week prior before, saying that they're going to keep the Fed funds rate will stay at the present lows through the middle of 2013, and now that you have a coupling of them buying these long-term securities, we're looking at the interest rates probably staying low. It's a matter of how low is what you just said, into 2013, I would imagine, because it doesn't look like much is going to change. And I think it's more of the overall view of the Fed of how they're looking at the economy.
Right. It's interesting, though, if low interest rates were the answer, we've been out of this recession already. Right? That's not really – if stimulus were the answer, we'd be out of this recession already. Low interest rates are not the answer.
Yep.
They have to be coupled with demand. They have to be coupled with different lending standards. They're not.
Yeah, and the thing for a lot of homeowners out there or renters that are potentially looking to purchase, they're not necessarily not wanting to take advantage of the great rates right now. And I think that this is one of the biggest misconceptions with the general media out here, that they're pushing, interest rates are at all-time lows. But you know what? You've got to really be credit qualified to be able to get those rates these days. And it seems as though there was another article. I can't remember what it was. Let's see. Maybe it was the Associated Press, which was saying that the U.S. housing market is bipolar. And I thought that was an interesting characterization of the market. Basically, they said Michelle Conlon, the Associated Press, was saying that the high-end market with the luxury market is really the only thing that's moving and actually having some appreciation in home prices, and the lower-end market is the one that's kind of dwindling and not much is happening. Well, I would say that it kind of makes sense to me because, the people that have a lot of money that's just been sitting on the sidelines or the rich are now choosing to move forward and to buy their dream home because they can still capitalize on these low interest rates. So that does make sense to me. However, I think that, we always talk, Lewis, about all markets being locals and hyper local. And in the DC metro area, I'm actually seeing all, sales prices all along the spectrum all increasing right now. And really, I think the biggest driver in that is that we have a better employment around the DC metro area with the government contractors, but also we have one of the lowest rates of foreclosures throughout the country. In the general area of Northern Virginia, Maryland, and D.C. Now, some parts of Virginia are a little bit different. But for the most part, it's allowing even new home builders. Lewis, you had sent me an article that had mentioned that new home sales had fallen for 4 straight months.
That was released today. Down to 295,000 last month.
Right. And, in the D.C. metro area, this is a completely different dynamic. I actually had a client that bought into a new home development. Rodney was his name. And we were talking. It was so funny. It was about 6 months ago he moved in there, and he didn't buy one of the new home sales, but he was looking at them. They were priced at about probably like $4.25. He was looking at a short sale up the street that was priced at $330. He didn't end up getting it at $330. He got it at $360. So about a $60,000 discount from what the new home builder was building, and his house was about 4 years young compared to the brand new ones that they were selling. So a $60,000 difference. Now, granted, he had to do some upgrades in his house to kind of bring it up to par. But which is interesting now, that same $425,000 house, the new home model, is now selling for $465,000 6 months later. And I think that that's a very good indicator to kind of tell you where prices are going, especially in the DC metro area. There's there's not much supply of good homes, and people, I think, are getting frustrated in their search of a new home and finding short sales not the best option because they have to wait a lot of the time 6 plus months to find out if they're even going to get the bank's going to agree to it.
Right, and you have to do repairs as well. The advantage of a new home is you can supervise the construction to a certain extent and get the home the way you want it when you move in.
Yeah, and then there's always the argument too that you can essentially, the cost of money is so cheap right now, Lewis, that it allows you to buy a little bit more of a house than you otherwise could before. So if you're looking at a house that might be similar, that's not brand new, and it's, 30,000, 40,000 less, you can kind of justify, well, my payment's only going to be $100 to $200 more. And I think that's what a lot of people are doing. Numerous listeners I've actually talked to that were considering new home developments, and they just think that it's really the best option just because there's not enough good homes on the market right now.
I wonder of the new home construction. I only saw the national numbers. I wonder how much of that is in the Washington, D.C. metro area. It sounds like
I would say a tremendous amount, to be honest. I don't have the hard numbers in front of me, but I would venture to say that a majority of it is in this area.
Because I know that construction is virtually stopped in certain areas where 60% of the homes are foreclosures or short sales. There's just no point even trying to compete as a home builder in those areas and putting up a new home and then trying to get a decent price for it.
Yeah.
But it sounds like in the D.C. metro area you can get it because there's a shortage of homes that are on the market, and then you have to go further down. There may be homes on the market, but they may not be the type that the buyers want. That's where the home builder does have somewhat of an advantage.
We're talking with Louis Cammarosano, the general manager of HomeGain, and we're discussing what home prices are doing in the D.C. metro area and new home sales in the D.C. metro area. Another interesting thing, too, Louis, is I think that really, the shortage of foreclosures and short sales in this area is the ultimate thing that's sending more people to those new homes. I think that more and more I'm seeing clients that are just, when they're stuck with the option of, do I have the means to put $50,000 into this house? Do I have, am I able to qualify for a renovation or a rehabilitation loan? Those are all the things that they're falling into, because with a standard, let's call it FHA government loan, it has to meet minimum criteria, like it can't have ripped out carpet in the basement. So carpet would have to be put in before they could get that loan, unless they chose to get a rehabilitation loan, which would allow them to do that, which we talked about this, I want to say a couple months back when we were talking about FHA streamlines.
Mm-hmm.
And I think the more complexity that you throw at the buyer, the more they get kind of scared and just kind of move away from them. And in the D.C. metro area, the other interesting thing that I've noticed is that even the foreclosures are being priced more closer to the actual market value. There's not these deep discounts of down to 50 and 60% that the rest of the country is realizing. So I think that that's another interesting dynamic to look at.
Right, a short sale, a lot of people have a misconception. A short sale is just what the bank is willing to accept, and if the market is bearing it, they don't have to really take that much of a haircut.
Exactly. And, sometimes those short sales, you have the cost of waiting on those, where if this short sale were to start right now and it doesn't get approved for 6 months and home values are increasing during that time, you might not actually get it at the price you wrote the contract. And I think that's what a lot of those short sale contracts that fall through, Louis, are those ones, because the people are like, well, I want this house, but I only want it at this price. The bank comes back, says, you know what, $330, the comps are now supporting $360, so we'll sell it to you at $360. And then they decide to walk. Well, they might have wasted 6 months of their time doing that. Now, a lot of the agents in this area that are smarter always know to continue their search and always look for something better that's not a short sale.
Right, but that dynamic actually also falls into the favor for the home builders.
Yep.
Now, I just read a statistic, which is interesting. When you and I have talked about this, that really a robust new homes market is better for the economy than just the traditional existing homes, even though that new homes make up about a fifth of the homes sold, because new homes actually create more jobs. And there's a statistic that says that each new home built, according to the National Association of Home Builders, creates an average of 3 jobs and about $90,000 in taxes. So there's more people going to work as a result of the construction of a new home than merely just the passing on of a existing home to another buyer.
Yeah, makes a lot of sense, and it actually makes, exactly why the D.C. metro area, I think, is doing better than most. Creating more jobs, more revenue. When we come back, we're going to kind of segue into HomeGain's third quarter 2011 Virginia Home Value Survey and let you know what that means to you and your real estate in Virginia. Be right back.